Good afternoon, ladies and gentlemen, and it's really great to be at the first Cogence Summit. Let me just begin by thanking everyone from Discovery and from BlackRock that have really made today so far a fantastic event. So let me get going and try kind of sum up a lot of the key themes that have been mentioned this morning and really concentrate on retirement planning for your clients. Of course, we know it's been an incredibly complex and volatile environment. There's increased longevity. We know clients are living longer as medical technology continues to improve, and retirees are outliving their savings by more than a decade. We've heard from Liam, Karim, everybody, how complex investment markets are. It's incredibly difficult for you as financial advisors to actually navigate such a complex world going forward. In excess of 140,000 funds that you have to think about on a global basis. And then, of course, the need for technology as time progresses. As you need to actually confront these complexities, one needs technology to be able to do that. And of course, that's all compounded by the effect of regulation. We've heard a little bit about Reg 28, which recently pushed the offshore allowance up to 45%. And of course, recently, the two-part retirement system as well, which of course will impact our clients' retirement planning. So let me start off with the graph that really talks to replacement ratio in retirement. And if you think of someone at age 65, and you kind of assume that they had the appropriate retirement fund, the right replacement ratio. But of course, a lot can happen to a client over those years in retirement. If you think of the average life expectancy of a Vitality client being around 83, if a client in fact was sicker in those earlier years in retirement, they will typically have 3 times more out-of-pocket medical expenses. That will impact their retirement fund. On the other hand, if a client had to live 5 years longer than the expected, than the life expectancy, that will further reduce their replacement ratio, typically below 50%. So it's quite a complex advice spectrum that you have to think about for your clients. Of course, if you're able to actually optimize all of this and shift that curve up, make sure you've got the right assets and that the money lasts for a healthy retirement, you've really achieved the gold standard. So of course, the actuaries in Discovery, myself included, we like to bamboozle you with a formula in every presentation, but it's actually very simple, and let me explain it to you. On the left-hand side, we're trying to work out how do we maximize the retirement income sufficiency for your client. And really, it's built up of 2 sections. Number 1, the accumulation phase, building up that fund prior to age 65 in a typical retirement age. And then, of course, in retirement, the drawdowns. What do you draw down and make sure that that fund will last for the life expectancy of the client? So really, there's a savings behavior we have to concentrate on. There's getting the right return for clients, and then making sure that we're managing or understanding the implications of life expectancy. And of course, advice is pivotal in ensuring that clients have the right retirement fund. So let me delve a little bit into savings behavior. And of course, so clients made rational decisions, right? They had complete information. The choices were so small, very few choices in terms of retirement planning. They had consistent preferences and really wanted to maximize the profit. It seemed actually that they were making very rational choices. But of course, as Grant has just spent a lot of time taking us through the fact that clients are actually largely irrational. And that's what we've discovered. There are so many books and papers that have been written now in terms of decisions are shaped by how losses are perceived. In other words, the concepts of loss aversion, herd behavior, people just following what others do, not understanding risk appropriately, regretting certain decisions, being overconfident, the lottery effect in making very specific kind of choices, and then hyperbolic discounting. And that's really an important factor in the advice process. Of course, I'm sure as you go to many clients and you ask them about retirement, they'll tell you we'll start in 10 years' time. We don't have to worry now about it. They kind of think that they'll be able to catch up at some point in the future. And maybe that rationality was understandable in the 1970s because pension funds in those days were all defined benefit. You knew what you were putting in, you knew what you were getting, and your pension was guaranteed. But the world has changed. It's all defined contribution. The total risk of the outcome is borne by you as the financial advisor and your client. There are no guarantees in this financial planning. And I mentioned the hyperbolic discounting, the cost of starting too late in making these investment choices. If you look at an example, someone trying to get a replacement ratio of 75% at age 65. If they start saving at age 20, well, then they only need to put about 13% of their income into a retirement fund. And if you think that many people are part of an employer pension fund and their own arrangements as well, that's not that difficult to achieve. But of course, just move that decision out to age 30, you need to put 22% of your income away, and delay it to age 40, it's largely impossible to get the right result. So certainly important to get clients starting for retirement as early as possible. But of course, once you get them in, you've got to keep them in for the whole course. We know with recurring investments, clients often make the investment paid up after a couple of years. So here's an example of a 45-year-old, a 20-year investment time horizon to age 65. If they make it paid up, in other words, they stop contributions after 5 years, they'll have roughly just over a third of their retirement goal. If they go to 10 years, they'll have close to 2/3. And of course, even at 15 years, they haven't quite got there. So it's really crucial to keep our clients advised and invested for the full duration. Of course, we don't know the impact of the two-pot system, which can further, of course, depress the situation that you see in these numbers. So we believe very much in Discovery, in all of our product houses, that product design is absolutely key to facilitating behavior change. We know the science of loss aversion. Clients don't want to lose something that they have. And therefore, as you're familiar with in the Discovery world, we boost our investments up front. We give clients more money on day one. If you invest 100,000, we will invest up to 120,000 for you. That extra 20,000 going into the same choice of your underlying investment, your main investment, or in fact, it can all go offshore. But clients stay the course because they don't want to lose that money, which only actually vests for them at retirement. What is the result? It's profound. The actuarial dynamics have really played out incredibly well. We've seen roughly a third reduction in the lapse rates for clients who follow this type of system. They have invested on average 3 years longer with us. They contribute on average 82% more ad hoc contributions to their retirement plan. They draw down less in retirement, and bringing this all together, they have roughly double the fund than someone would have than someone who didn't engage in all of these incentives. So it works incredibly well to incentivize clients and impact their behavior through these incentives. Let me move on to the second component, which is really the science of portfolio construction, and that's where Liam has spent so much time earlier this morning with the rest of the BlackRock team. So portfolio construction just looked a lot simpler a decade ago. A lot less funds in the market. Reg 28, if you remember, was only 25% offshore in those days. Less funds available, more cluttered or clustered type of returns, and people weren't that worried about getting the wrong investment choice. So what has changed since then? Well, there's been a massive proliferation of funds. There's a huge amount. You guys see it every day, the number of unit trusts in the market. And of course, there's a perception that the lower the fee, the better the performance. But of course, that's totally incorrect. As the scatter graph shows you, you've got funds at different levels of fees, high fees, low fees, getting top performance, and on the other side, getting poor performance. And then clients are also irrational in looking at past performance to make decisions. If you look at the right-hand side, I've shown there funds that were in the first quartile from October 18 to September 21. If you look over the next 3 years to September 24, only 56% of them had above average performance. The other 44 were below average. So past performance really is not a strong measure of future performance. And of course, as mentioned earlier, we've seen a much higher dispersion in returns. If you look at the S&P 500, the stocks inside the index, the gap in the movements between, or the differences between the top and the lowest performing stocks has increased dramatically. It's a much more complex environment that our clients are navigating. Okay, I'm hoping this is my water and not Grant's. So what you see now is that with Reg 28, of course, the picture is a lot more dispersed. The risk is higher because a lot more funds can go offshore, and the returns will be more variable over time. It's early days in Reg 28, but you can expect when you look at this in 5 years' time, it's going to look incredibly different. And I think that further just increases the complexity for you as advisors. That increased risk really manifests in a lot of conservatism. These are the CISA stats every year since 2009, and you can see where the money has gone in the South African market. The dark blue bars are really the income funds. So since 2017, people have put their money into income funds rather than into balance funds, into equity funds, etc. Okay? It might have made a little bit of sense over the last 18 months when interest rates were higher. But in fact, if you just think how many of your clients are sitting in income and have missed out over the last year's bull market locally and overseas, it far outweighed the extra interest that they would have made over that period of time in income funds. So really over conservative because of this fear of loss. And I guess that talks to why we believe having solutions in place that you can just rely on and follow over time is so important. The cost of getting this wrong is really significant. This slide just shows different asset allocations, and over the period that we benchmarked it depended what your asset allocation was. But you can see the income could have varied from only 15 years worth in retirement up to 25 years in retirement. So the cost of getting asset allocation wrong, fund choice wrong, it's absolutely enormous and something that advisors have to be aware of. And therefore, we believe there's no substitute for scale, and hence the Cogence team were very insistent on having a collaboration with the company of the gravitas of BlackRock. BlackRock don't like to say, they like to say we're one of the largest asset managers. I'm going to take the liberty to saying they are the largest asset manager, okay, globally. They have a team that is taking a huge universe of funds, over 140,000 funds from many different asset managers, putting it through a BlackRock manager research engine, which distills that into a focus list, and then further reducing that to a defined list of funds, which is included in their solutions. So it's an incredible engine behind the Cogence solutions, and we think that's incredibly powerful and, of course, comforting for advisors and clients. But as was mentioned earlier, Aladdin technology, which is not just used by BlackRock, it's used by most of the largest financial institutions around the world. Banks, asset managers are using this to run their portfolios. Aladdin is incredibly important in our lives as well. As Leah mentioned, they take in excess of 3,000 granular risk factors into the technology. That's a massive amount of data that has to get processed across all the various asset classes to make the decisions, to get the risk factor decomposition, to provide the deep dive analytics, but also importantly to give you as an advisor stress tests for the future. What would happen in the portfolio recommendation if, say, oil halved or the rand went to a certain level, etc. So it's incredibly powerful technology. What we have done is we've taken and worked with the Aladdin Wealth team to create a retail version of the technology for you. So you have this in your office. When you do a client proposal, it is done through the use of the Aladdin Wealth technology. And then let me move on to the last part, which is really understanding life expectancy of our clients. Now, we know life expectancy is increasing across the globe. This kind of shows by continent what the expectation is by 2050. Of course, there won't be a day that goes by where any credible publication won't have an article on wellness, on improvements or innovation in the medical space. We know clients are engaging virtually with doctors. Globally, they're consulting medical experts. On the right-hand side, we know that there are significant breakthroughs. If they could be made, they would have a big impact on future mortality of our clients. And in fact, the size of the bubble really shows the impact on mortality. The exciting part for me in this graph is really the horizontal axis. It shows the number of years till this medical technology actually has a real impact on our lives. It's not far away. Things are there that are going to happen in the next 5 to 10 years that are absolutely fundamental to our clients and their longevity. But of course, as financial advisors, very often when you do planning, and we often get the call, what should we use as like the life expectancy for a client? And we tend to think of an average. The average, which we see in Vitality, is 83. So people look at 83 and plan for that. But you should know, sitting in the audience, that 60% of your clients are going to have a life expectancy above age 60. Right? So for every 100 clients you've got, 60 of them are probably not being thought of correctly in terms of how you're planning that they've got sufficient assets in retirement. And therefore, we think of the concepts for a client of their total lifespan, how many are healthy years and how many are sick years. And really the objective is to maximize the healthy years and of course minimize the sick years. On average, and if you look at almost all countries globally, on average, more than 10 years are spent in poor health. So what do we know? We know that people are living longer, but in poor health. And we've seen that, a 15% increase in the number of years spent in ill health between 1990 and 2019. We know that the number of people diagnosed with dementia will increase, it will double by 2050. This all has a major impact on retirement income, whether it's clients needing to upgrade their medical plans to cover more, whether they need additional insurance, or whether they have to fund home care, frail care, etc. This will all impact them dramatically in retirement. If you look at the US market, it's so interesting to see that your client's health has become such an important part of their financial plan. This shows the percentage of median income that is being spent on healthcare. And you can see how that's just increasing every year. It's a pity the graph stops at year 2020. I have no doubt if it went to 2024, this would look worse. And we expect it to continue. As medical innovation comes through, the price of it is expensive. We also know from our Discovery Health database that the average claim of a sick client in retirement is considerable. It's in the order of 200,000 Rand compared to a healthy client where the claim amounts are very small. We know that retirees in poor health will spend 3 times more on out-of-pocket expenses than those in good health. So these factors have such a big impact on what you thought was the reasonable pot of assets for their retirement. And now, of course, who knows if that is actually going to do the job or not. It's very interesting that a survey was done. There were 55-year-olds were asked, well, there was a group of them that were healthy and a group of them that were sick. And every 2 years for 10 years, they were asked, how do you feel? In terms of the healthy clients, 1 in 10 spent more than 5 years being sick. In terms of the sick clients that were asked at age 55 and every 2 years thereafter, 7 in 10 spent more than 5 years being sick. In other words, the current health of your client today is a good predictor of where they're going. Okay, if they're not healthy today, good chance they're continuing on that trajectory. On the other hand, it is possible to change the number of healthy years of a client. On the right-hand side, it shows a 30-year-old male, poor health, and it shows that the healthy years for this person was roughly 17 years. But of course, with all the interventions, for example, through a Vitality type of program, you can see that one can dramatically change the longevity and the healthy years of our clients. And that's really a great opportunity to ensure that whilst they live longer, they live those longer years being healthier. So really, how do you optimize for retirement? Number one, savings behavior. Okay, one needs to make sure that clients are investing the right amounts of money from the right age every year. They're topping it up. They're making sure that that pot of assets grows for retirement. Number two, it's getting the right return. That's our whole collaboration with BlackRock. We totally believe that through Cogence, you're able to get the solutions that deliver that for you. And thirdly, in terms of life expectancy, there are great tools through programs like Vitality where one can actually manage and help a client in terms of planning to have the healthiest possible retirement. I mentioned to you the Aladdin technology which creates the proposal for you. And really, it takes you through these 3 steps, and you can get our sales team to show you how this works. Number one, ensuring you manage the savings behavior. You want to up that curve. The normal replacement ratio, you want to build up a bigger pot of assets. And that's shown, that's one of the screenshots of the proposal. Secondly, using the Cogence solutions, what is the impact? It will analyze what portfolio is your client in today, what are the risks associated with that, what changes need to be made for the future to have them on the right savings trajectory. That further moves up the pot of assets. And really, okay, the real prize is moving it even further to the right, improving their health in retirement so that they actually enjoy their years in retirement and they have adequate assets for that entire retirement. So ladies and gentlemen, that's it from me. I want to thank you so much.